Andres Garcia Maya. He is the founder and CEO of Zoe Financial, and Tom Lydon is the CEO of ETF Trends. Andres, let me begin with you. We had a guest yesterday who used a kind of interesting illustration. She said that equities have been going up as if on an elevator, and the economy, meantime, has been going up as if it was taking the stairs and stopping on the landings. How do you see the economy unfolding from here? We just heard from Lael Brainard, of the Fed governor, and very cautiously speaking there. What do you see for the economy, and how is that going to affect my money and my equities?
Yeah, a bit of a head scratcher in the sense that when you look at the economic data versus where the market is, right? And I think a really interesting data point to look at is the composition of the markets now versus the last cycle. So just to give you one data point, the energy sector accounted for 13% of the S&P 500 in 2009. Right now, it is 2.6% of the S&P 500. Why is that relevant? Because energy stocks are down 39% year to date versus the tech sector, which is the largest sector, now 27% of the overall S&P 500, is up in double digits, right? So if you think about it from that perspective, what that tells you is that the market composition is no longer as economic sensitive as it was in prior cycles. It doesn't mean it's immune to it, but it does help explain some of this discrepancy of the markets doing much better than the overall economic data, or sectors that are tied closer to the economy, like energy stocks or bank stocks.
Are you making an argument, Andres, before I bring Tom in here, are you making an argument indirectly for putting money into these sectors that are no longer so large in the S&P because they're down so much this year, or they're not the fashion right now?
I would look at it this way. I'm explaining what is happening now rather than predicting, right? Mm-hmm. So it does help explain why this is happening. It's not random, right? Technology stocks are not closely tied to retail branches, and therefore they were not as affected. In some cases, it's actually changing habits of the consumer towards their type of business, right? So it would help explain it. If you're thinking about it from the perspective of valuation, value stocks versus, for instance, growth stocks are at, over a decade different divergence of valuation. So if you look at it from that perspective, value does look better than growth, but it might take another decade for that to be reflected in the actual price.
Yeah, who wants to wait that long? Who wants to wait that long? I'm asking Andres. Tom, let me turn to you. In the past couple of days, we've seen a little bit of a retreat from some of the momentum stocks, some of the cloud companies that we mentioned at the top of the segment, some of the tech stocks that were doing so well until roughly this time yesterday, and when they started to pull back just a bit. Do you think, as we began this segment by asking, that the tech trade or the cloud trade or some subsets of it are overcrowded right now and therefore telling you to move somewhere else?
I don't, Tyler, because when you look at the flows, there's so much money that's moving into new economy stocks. Andres did a good thing in outlying sectors. It used to be in the last 10 years, you just buy the S&P 500. It was really tough to beat it because collectively all sectors did well. But now we've got a whole group of sectors that are doing really poorly, like banks, like energy, like travel and leisure and transportation. But when you look at communication services, information technology, those companies are really doing well. And part of that is their growth phase has really been sped up because more people are changing the way they do business. They're working from home. They're embracing technology in a way that they never have before. And they're having to do that in order to operate their businesses in order to be profitable.
Well, you look around my house, so I've been broadcasting from my kitchen, and truly we could not have done it. Neither I nor my wife could have done it without the products that come out of Silicon Valley, largely Apple products, but not necessarily exclusively so. And yet you like some of the bank ETFs, right, Tom?
Well, before when we're talking about banks, there are definitely some opportunities. And Bob Pisani did a great job laying out the landscape. However, all banks are not created equal. The big banks have some buoyancy in the fact that they've got other businesses outside of lending. Bob touched a little bit on regional banks. There's another ETF, which is KRE, the regional bank sector, which is more exposed to loans. And if, in fact, you feel like this recession that we're going through is going to be V-shaped, there's a greater opportunity there for sure. However, as Jamie Dimon said today, the tail end of this is probably a little bit longer. We have yet to see, and basically it's going to be a marathon and not a sprint. If I were to choose, I wouldn't necessarily go into financial services and banks right now. I would stick with information technology. I'd stick with actively managed ETFs in that space. In particular, ARKK, the ARK Innovative Technology ETF, has some really innovative financial companies in there that are like Square, like LendingTree, like Zillow, that are really doing well in this environment.
All right, gentlemen, thank you very much. Tom Lydon and Andres Garcia Amaya. We appreciate your time today.